One of the most widely followed fund managers on Wall Street put out a note to clients last night, airing first on Fox Business from Guggenheim's Scott Minerd. Here's his take on the session selling spree. Quote, "To be clear, I am not saying the worst is over, but rather it is time to take a break and assess the next moves." He's here, the co-founder and global investment officer for Guggenheim, managing $265 billion. Intra-meeting cut. I need your prediction right now. Will the Fed pull that ripstop on the parachute and not panic, but make an emergency rate cut?
Well, it's interesting, Liz. If they do it, if the market's where it's at today, I think the world will view it as panic. If the market's down 20, 25% from its highs, they'll view it as something that's reasonable. So I think the Fed will wait as long as possible before they act to reduce rates here.
Yeah, we're down 10%, just a little over 10% from the recent highs for all of the major indices on the screen. So that's called a correction.
Right.
It's not a bear market. We need, as you say, to get, so you would probably guess that the Fed would wait till we're down more like 20%.
Right. Yeah, I think, look, we understand the Fed reaction function. December 2018 showed it to us. The minute the market broke below 15% down and headed for 20, the Fed was on the television the next day pivoting on policy. So they can't stomach a bear market here. And so I think that, but again, they don't want to be viewed as being panicking, because I think they could be concerned that they're sending the wrong signal to the market.
Yeah, and that is your prediction. It's interesting because Terry Duffy of the CME just came out and specifically said he thought it would be a bad move for them, but you're actually saying they would most likely wait till they see 20% drop.
Well, if they acted now, I think that would be viewed as that the Fed knows more than they do, and that they have major concerns, which would just set the market up for more downside.
I need to know, because it is changing hour to hour. What do you make of what's going on right now? Do you see it as a real opportunity? In retrospect, 4 months from now, will people be saying, should have bought right there?
Yeah, well, you know, I often joke the most expensive sport in the world is bottom fishing. So I think it's a little premature to be stepping in right now.
Premature.
Yeah, but you know, and I do think that this 3,000 area on the S&P, that this will be an area where we can consolidate until we get more information. But, you know, when you consider that this is close to turning into a pandemic, you know, the impact on the U.S. economy, if it really happens here, will be much more dramatic and could affect earnings and, you know, and the economy overall. So
you're suggesting it's okay to scoop up a little bit of double B credit junk bonds.
Right.
Okay, so that's less than investment grade.
Right.
But which areas?
Also, well, in particular, Kraft Heinz looks very interesting because it just got downgraded from investment grade. It's trading very wide to U.S. Treasuries. What's
the yield?
Around 5%.
Okay.
And if the market rallies if we are going into a pandemic, and spreads are going to widen on high yield, you know, we're going to have the 30-year bond at 1%. We're going to have the 10-year note at 0.25%. So, you know, you're going to be able, you know, these things are still going to look attractive.
You worried about oil? I mean, look at crude oil. Oil is down about 12% week to date. Are you hearing any sort of green stick fractures in the hedge fund world, or predicting anything? Not yet,
but you know, 2 weeks ago, I wrote a commentary on the coronavirus, and I pointed out that you know, the technicals, if we broke below the lows, would put us on target to go to $25. So you know, we're there, and so I expect oil is at least going to 40 and probably going to go lower before this is over.
Okay. I need to know about yield curves.
Right.
We are seeing an inversion of the yield curve, which, for people who don't know exactly what that means, when the shorter dated treasuries are yielding more than the longer out ones, like the 3-month versus the 10-year, for example. You know, that's a sign of a recession coming. Right. Do you see a recession? Because in your note that came out last night, you said that you haven't seen anything this bad since what was expected in the Spanish flu in 1918.
Right.
So is that's depression era? Do you see a recession or even a depression?
Well, I mean, look, there was a severe downturn that followed the Spanish influenza. And I think that, you know, if we get this into the pandemic stage, we are going to have a recession. I think at a global level, we're very close to recession right now. When you take the average of all the GDP around the world and whether it's growing or not, Europe has probably already slipped into a recession. I believe China is clearly in a recession at this point. So, it's just a matter of, how long it takes to hit our shores and can we get it stopped.
I've got to ask a very pointed question here. We have seen countries go negative on their interest rates, whether it was Germany, Japan, and I think the entire bond yield curve for the German Bund market went negative the other day.
Right.
Do you foresee negative rates for United States?
You can't rule it out. I think that
wow.
If we go into a recession now, and given where interest rates are and where global rates are, we are the high yield alternative for the world. There'll be so much capital flooding into the United States that I think it's very likely we would push rates into negative territory.
That's a bad thing, is it not? That means people would rather park their money in government treasuries and get back less.
Right. Well, and in a sense, it's a tax, right? I mean, what's happening is the government can borrow at a negative rate, and you pay them to give them your money. So it's a form of a tax on savings.
What worries you most here? Is there a trigger you're looking at where you hit a certain point? Let me rephrase that. What are you looking for that is that screaming signal that will tell you, now you get in?
Well, look, there are two things I'm looking for to find out how much worse this is going to get first. One is, if the stock market breaks meaningfully below 3,000 on the S&P, I think we're going to be down 15% or more. The other side of it is the pandemic data, the epidemic data itself.
We forgive you. Do you think it's a pandemic? Come on.
Well, here's the definition in my mind, right? If our neighbors have it, it's an epidemic. If we have it in the United States, it'll be a pandemic. And that's the way people will look at it. That's the way the economy will look at it. So, the question is, can we keep it contained? And I'll be honest with you, Liz, I've talked to a lot of experts. It's virtually universal, and what I get back is it's virtually impossible to see how we can contain this. So, it's premature to hit the panic button, but it's certainly not time to be taking on a lot of risk assets like high yield or stocks.
You've just made quite a bit of news. You say we would have to wait probably till we're down about 20% for the Fed to move, but you also say that this is about the worst that you have seen and that we may very well see negative rates. You can't rule it out. I don't know if we can bring up the volatility index, but as we have just talked about Apple, Scott Minerd, what do you make of this? Because, it's down 5.5% right now.
Right. Volatility
has more than doubled over just the past couple of days, and that's for the entire market. Annual low is 169. Apple's at 277. Annual highs at 327. Would you buy it here?
Again, I think buying almost anything that's affiliated to the China situation is like catching a falling knife.
Or machete.
Yeah, exactly.
It's a falling machete.
If you want to lose your arm, you go for it. But I mean, look, it's obviously to me, the Tim Cook visit to Birmingham is a PR attempt to shore up confidence among the employees and to get his face out there, because obviously, Apple has got some severe issues. That they're not going out of business, and there will be a buying opportunity here at some point. But, right now, I think it's a little premature to step in.
Although I would still say, okay, month to date, it's down about 10.6%, quarter to date down 5%. But Apple is absolutely not going away. I actually applaud Tim Cook for getting out there and showing some leadership here. But why aren't we seeing more CEOs doing that? I'm talking about the airlines.
Right. Well, look, the airlines are sort of ground zero here. And Tim is a class act. I know him. He is doing the right thing. We need to see more of that coming from corporate executives to, help boost confidence. The president's speech last night was obviously an attempt to boost confidence. But the minute he goes off the air, people begin to panic. And so, the president can't carry this load alone. We need other people to come forward. And look, this may be, as Churchill said, I doubt this is the beginning of the end, but it is probably the end of the beginning, right? So, you need to get out there, as somebody like Churchill would, and say, look, you know, we're in this fight. We're going to survive.
Of course.
We're going to find opportunity in crisis, and let's go for it. And let's be positive and gung-ho.
I like that.